a little later, but at the moment it's the Chinese central bank cutting interest rates that's going to be top of the market's mind as we open on Monday. This will mean certainly some more money coming towards China. This makes it the second central bank in just 24 hours to have a loosening policy as it is. A couple of weeks ago we had the Fed pushing out the rate hike and therefore in a sense maintaining the loose monetary policy. Yesterday Mario Draghi in no uncertain terms said that 1.1 trillion euros of bond market purchases will likely be increased, expanded, and that the discount rate also could be cut come December. And here's the Chinese central bank responding along with all central banks, or probably to compete with it, to cutting interest rates. This is a very big development. Raghuram Rajan has been warning that there is competitive devaluation that's happening, and here is another instance, not directly perhaps attacking the currency, but it is bound to have its impact on the currency. We also have the BOJ meeting next week, and it will not be impossible that Mr. Kuroda will have to respond to three big central banks, European, Chinese, and in a sense the Fed, resorting to kind of liquidity oriented policies. And here's the Chinese move. That's a 0.5%, that's a 25 basis reserve requirement cut. Okay, so it's both, is it? This is a reserve requirement cut by, this is what their equivalent of a CRR. Is there also an interest rate cut? We will have to see. So this looks like a double dose from China, or is it a single dose? Is it only a reserve requirement cut by 25 basis points, or is there also a interest rate cut? Anything that you are able to get from the wires?
Not as yet, Lata. We still don't know about what it is at this point in time. I'm just trying to look at it. Right now, we don't.
Well, it clearly looks like there is a reserve requirement cut, which is their CRR. The amount of ready cash that banks must keep, that has been cut by 25 basis points. Is there also an interest rate cut? We do not know at this juncture. But I can tell you from the way in which other banks are responding, a liquidity infusion is usually more effective than even an interest rate cut. An interest rate cut is a signaling cut, whereas a liquidity infusing cut actually brings in more yuan into the system, more renminbi into the system, and that will bring down rates more effectively. That will pull down the yuan more effectively. So a fall in the yuan rates in the days to come should be expected. As you just pump in more yuan, it's but natural that the value of the dollar will go up and the yuan will depreciate. So some kind of an impact on the yuan cannot be ruled out. Okay, to cut reserve requirement by 50 basis points for some institutions, as well 25 basis points for everyone, to liberalize deposit rates for commercial banks. This is very important. In China, both the deposit and the lending rates are largely regulated by the central bank. Now they're going to liberalize the deposit rates so that banks can charge anything they want for deposits and not go by the central bank. So to cut reserve requirements by 50 basis points for some institutions, which they call qualifying institutions, as well a 25 basis point cut for all institutions. This comes into effect October 24th, that's tomorrow. This is a very, very big and quite an unexpected move from the Chinese central bank. After the ECB announcement yesterday, all eyes were trained on the BOJ. A cut from China was not quite on the cards, at least not for the markets.
Yes, and we just have a couple of indices which we should possibly pull up. For example, the European markets have been holding with a gain of around 2 to 3 odd %. So, for example, the German index itself is up around 3 odd % at this point in time. And the Dow futures also are indicating that it would be a gain of around at least 1% in terms of a start of trade. So we'll have to wait by and see how they negotiate with this news, as well as the tech earnings which are expected out from the US market. So as of now, it seems as though the global risk on is taking place, and this would be a clear evidence of a liquidity push into the global markets.
Maybe we want to get some forex traders to respond to this, because the foreign exchange market in India is still trading. Maybe we want to pull up the rupee and look at the intraday chart of the rupee, as well look at the European markets and check out what the impact is. The European markets will come up for you in just a minute. One should expect some impact on all these markets as well. That's the European markets for you. That rally is just going through the roof, as it were. So more liquidity coming into all systems, but one as yet doesn't know whether this is the way the European markets will continue to surge. If the reserve requirements ultimately have a depreciating impact on China, then it's quite possible that it may not be very good news for European markets, because a depreciating Chinese currency will not necessarily mean good news. But at the moment, all markets are reading it positively. It could actually mean that China's economic activity will pick up. And if this big engine for growth ticks up even, by 10 basis points, that's good news for the whole world, which is what I think these risk markets are responding to. We must pull up the European markets. Those are the markets that are trading now, not the Asian markets. And I think the European markets are responding to exactly that. If all the central bankers were to loosen their purse strings, hopefully there will be more demand. Hopefully there will be more growth, and that will be good for all markets. So the DAX has gone through the roof, as it were, 3% higher on the DAX. The CAC also almost 3% higher, and the FTSE 1.7% higher. Let's pull up the rupee as well to see if there is a concomitant impact on the few markets that are trading in India, the rupee and the bond markets. This will be seen as a risk rally. The rupee was strong, remains strong, but this is, at the moment at least, being seen as very positive by the global risk markets.
Yes, in fact, the rupee, I think, has appreciated as we speak. So we'll wait by. We need to see an intraday chart really for the rupee markets at this point in time. But nonetheless, this is a big move which is coming in, indicating that global growth is not out of the woods, and we really need impetus on that.
Okay, well, there you are. That's the way the markets are moving up. You should expect perhaps more of the risk rally to continue in Wall Street as well. So Asia is all set for a very green beginning on Monday as well. But let's see how the Chinese moves impinge on the currency. We live in very interesting times with all central banks opening their purse strings. We'll take a break. On that note, we will come back. We have some expert joining us. We have someone joining? Okay, we have Jeffrey joining us. Jeffrey, how are you reading this Chinese...
Jeffrey Dennis.
Jeffrey Dennis, how are you reading this move by the China, by the PBOC?
Good morning, everybody. Yes, I've just heard about it, actually. I think it is positive news. We have been expecting for some time that the Chinese would cut interest rates again to try to support growth in the economy. And, of course, coming on the back of the fact that the Fed didn't raise rates in the middle of September and, of course, the commentary from Mr. Draghi yesterday, I think you're right. It will extend the risk rally for a while longer. So I think you have to view it as good news for equity markets in emerging, at least in the short term.
Okay, Jeffrey, does this mean that funds could flow into the Chinese markets and they would be preferred over Indian markets?
I don't think so necessarily. I think, first of all, I think it was no real surprise that the Chinese did cut rates. I mean, obviously, one never knows about the exact timing. I just think it's going to continue the risk rally, at least for a period of time, into emerging equity markets overall. Now, it's not clear that India is necessarily the logical first place that investors would head towards. If there is a risk rally going on, they're more likely to head to some of the higher beta commodity-driven markets that have really been hit very badly this year, markets like Brazil and South Africa, also perhaps Turkey. So I don't particularly think that India will suffer relative to China at all. I think this is all part of more of a kind of global liquidity move, and I would expect to see all emerging markets benefit to a certain extent.
Okay. Jeffrey, what would this mean from a Fed perspective? Because they meet on the 26th and 27th of October as well. How does this change things?
I don't think it changes anything for the Fed. What would change something for the Fed in terms of global events would be signs of stability in terms of, for example, the Chinese economy, and I suppose financial markets to a certain extent. Clearly, the Fed paid some attention to the financial markets and the international scene when they decided not to raise rates in September. But I suspect that this particular set of moves doesn't make a lot of difference to the Fed. Our view is that the Fed probably does raise rates before the end of the year, most likely in December. But as usual, the Fed is going to pretty much respond as it usually does, indeed as its mandate says it always should do, to the conditions in the local economy. And so I would be surprised if this causes much of a change in the thought process at the Federal Reserve.
Jeff, two more questions with respect to India. Does this put more pressure, or is it likely to give more elbow room for the Indian central bank to cut rates? Actually, more pressure, because the Indian central bank has been slightly slow to cutting rates, except on September 29th when they cut by 50 basis. This competitive devaluation, so to speak, of their respective currencies, would it push the Indian central bank in any fashion?
I think it's certainly a factor that would tend to encourage the RBI to cut further. I think it's a little harsh to say India's been a little slow, actually. We feel the Indian Central Bank has done a terrific job in getting inflation down, getting inflation expectations down, and they were able to reward the markets for that with the larger than expected cut last time around. So I think all of this continues to put, I don't know about pressure, I think it continues to open the way for further rate cuts in India. We expect those to happen. I think to a certain extent it does depend on what happens on the currency front. The interesting thing being, of course, that given that the ECB has hinted about more strong easing, you've had a stronger dollar in the last 24 hours. That could, of course, eventually put some of the emerging market currencies under pressure again. So I think you have to see how the currency story plays out. But assuming the rupee remains stable, which it probably will do, I think, yes, it does increase the possibilities at the margin that you'll get more rate cuts from the RBI, even though our view is that we don't look for another rate cut until February. Oh.
Okay, it's hardly stable. It's actually climbing compared to every other currency, the rupee, that is. Please stay on with us. Jeffrey, Peter Elston of Seneca Investments also joins us. Peter, first it's Draghi and now it is the PBOC. Which are the assets you would chase now?
I'm sorry, the line isn't so good. Can you repeat the question, please?
Well, we heard Draghi warning of more stimulus, and now the PBOC has actually moved and cut reserve requirements. Now, which risk assets will markets chase?
Well, I think the action that we've just seen in China just reflects the fact that this slowdown there is very pronounced and it's very persistent. It's going to continue for some time, yes, and really what it's a reflection of is just how long the expansion was. It was actually in many respects a sort of a multi-decade expansion that we had really since the 1980s. China embarked upon an economic expansion that was based on fixed asset investment, whether that was in terms of building infrastructure or building property of one form or another. And you can only do that for so long. And so ultimately you started to see things slow down on that front, and it's going to continue for some time. And that means that these rate cuts that we've seen since, I think the first one was about a year ago now, are probably going to continue. And in line with that, you're probably going to see reserve requirements cut as well. So nothing too surprising, but there's probably more that lies ahead.
Okay. Peter, how does this change things for the global commodity cycle, if at all?
Well, I think it just confirms the fact that demand in China is still extremely weak, or at least it's weakening. And so, seeing the evidence of that in terms of central banks or the central bank in China reacting to that is probably going to make people realize that there is still a lot of weakness in demand for commodities. So I suppose on balance, this might mean that we see a bit of a pullback in commodities prices.
Okay. Stay on with us, Peter. Jeffrey, now do you think the EM fund flows that we have seen increases? It's just over the last 2 weeks that emerging market funds have started to see inflows. Does that increase?
Yeah, I think it probably does. In the short term, we've seen an enormous outflow, of course, this year. Of over $62 billion at one point, and then we've seen about $1.5 billion, or not even that, coming back in. So this is a trickle compared to what's gone out. But our argument has been for some time that, or at least very recently, that emerging market valuations are not necessarily very cheap, but they're certainly quite cheap in our view compared to developed market valuation. So this sort of liquidity move could be the sort of thing, alongside the clear capitulation we feel you've had in EM equities, could start to get some money coming back into the asset class. But frankly, as we saw in the spring when the Fed pushed the rate hike out to further into the year, effectively, we had a big liquidity rally. This has to be followed up by better growth numbers. Otherwise, it's just a liquidity rally, and eventually it will fade. So, yeah, I think we'll get more money coming back, but what we desperately need in EM is growth. We don't just need more liquidity.
Okay. Jeffrey, what kind of interest do you think developed market equities will see as opposed to emerging market equities? Do you see incremental interest, say, in European markets because of Draghi's statements?
Oh, without any question. Of course, I don't cover developed markets, but I know our European strategy team is pretty bullish about markets anyway in Europe, and this will only encourage that, because what you're seeing with what Draghi is doing is arguing that after a pretty good start to the year in terms of Europe relative to expectations on the growth front, you've seen some weaker data lately. He's determined to try to get growth moving and, of course, get inflation a little bit higher. So I think all of this is very bullish for European equities, and we would expect Europe to outperform. I'm not so sure about the U.S. on the back of this, but I think this is good news for Europe long term. I think it's probably good news for EM in the short term. Not so clear that it'll have a dramatic effect on the U.S. market.
Okay, well, actually, we are getting the U.S. futures rates. The Dow and the S&P futures are actually moving higher after the interest rate cut. We can also see, okay, the rupee is heading at 64.82. That's pretty much flat from where it was about half an hour back. So at the moment, the currencies are not reacting so much. Peter, what are the chances that this rally might peter out for risk assets? Ultimately, what are both these central bankers telling us? That growth is weak, that we need to stimulate more. So is it that, this rally won't have legs, or do you think it will?
I think if you look at the outlook for monetary policy, it's becoming much clearer. It's become much clearer in the last month or so that there is still a need to keep it very loose, that inflationary pressures really around the world are still very muted indeed, and that there having been an expectation in many quarters that the Fed was going to increase rates, that the UK wasn't going to be far behind, that's now changed, and I think there's an increased realization that monetary policy is going to remain very loose for much longer. Now, that is going to be good for risky assets. We've already seen, equity markets around the world start to rise again. And I would have thought that the chances are that will continue. The other commentator was talking about Europe. I mean, I would certainly agree with those views. We think that the outlook for European equities is better than in other parts of the world. The business cycle in Europe is at a much earlier stage of its cycle. Unemployment has fallen, but it's still very high indeed, and that's going to keep Draghi wanting to stimulate for much longer than in other parts of the world. So yes, keep a focus on Europe, but I think outlook for equities generally should be okay.
Okay. Peter, with that in mind, do you expect the Fed possibly hiking rates to go even beyond the expectations of March 2016? It would be pushed further on?
Well, that's a tricky question to answer. I think you've certainly seen expectations decrease in the last month or so. I suppose that in light of today's move by China, on balance, that would mean that expectations would be pushed out further. So I suppose if I was forced to answer your question, I would say yes, that there would at the margin be a change in expectation for what the Fed would do, not just the Fed, but other central banks would do in light of what the implications are in terms of the state of the Chinese economy, given today's move.
Okay. Well, final question to you, Jeff. Which is your best emerging market now?
I'm sorry, I missed the question there. Sorry.
No, Jeffrey, I was just asking you which would be your best emerging markets now.
Oh, I mean, in the short term, as I say, you'll extend the risk rally, and so some of those markets that have led the way in the short recently, such as Brazil, South Africa, Turkey, Indonesia, Malaysia, will probably be the obvious winners. But we wouldn't chase them because they're not the quality markets. We still prefer markets like China, like India. We like Poland a lot. We also like Russia because we think oil prices are bottoming out. So I think extend the risk rally for a while. Don't get too carried away. Then go back towards quality.
All right. Peter, Jeffrey, Dennis, thank you very much for joining us. So, well, that's the verdict. The risk rally probably still has legs because of two major central bankers, one cutting rates and the other one reserve requirements, and one clearly indicating that both an expansion of liquidity and a cutting of rates is on the anvil. The CAC and the DAX, after touching almost 3%, are now seeing a bit of profit, taking 2.8 and 2.5 for the DAX and the CAC at this point in time, and the rupee closing nearly flat after that rate cut announcement at 64.82. So market wanting to see how the China markets, how the China news will fuel other markets. At the moment, the Dow futures and the S&P futures are also promising to rise about 1%, and that's how the Asian markets closed. So it looks like the stage is set for some interesting competition among central banks to keep their currencies weak, and that definitely puts pressure on the Indian central bank as well to keep its currency weak. It's been the strongest performing currency, the rupee, and now there'll be huge pressure to bring down to depreciate the rupee in some form or the other. But the stage is set quite clearly.
To add to that, the India's forex reserves have risen to 353 billion as of October 16th.
Some $30 billion have been bought just in the last probably 3 months or so. So the Reserve Bank has been working overtime to try and depreciate the rupee, but it just refuses to. So much is has been the dollar inflow, and if this risk rally continues, then the Reserve Bank will have its hands full with dollars, as it were. Well,